The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Warm welcome to all of you to another episode of This Week in Intelligent Investing. Great to have you with us and great to have my co-host, Elliot Turner, as well as special guest, Daniel Prather, partner and director of research at Crossroads Capital. Daniel has been doing some very interesting research. We're actually going to have him on for more than just today to talk about different topics. Today, we will focus on one topic he has been excited about, has done a lot of work on, and I'll let Elliot kind of preview that before we turn it to Daniel. Elliot?
Great. Thank you, John, and thank you, Daniel, for being here. I think it's awesome to share that I first met Daniel after he did an idea presentation at one of the MOI conferences. I believe it was maybe 2 or 3 summers ago. And it was an idea that I also owned myself, but I was really impressed with the depth and quality of Daniel's work and found like considerable incremental insight. And I was like, okay, let me reach out to John, get an introduction to this guy and, pick his brain so I could learn a little more myself. And I think it's no surprise that Daniel has been top 5 at Ira's Own conference for idea presentation and a Vic idea contest winner. So, I've really enjoyed speaking with Daniel about a variety of ideas, not just the one that we overlapped on from that first MOI conference, but also several ideas, a couple of which may come up today. And today, part of why I wanted Daniel to come on the podcast is I thought it would be really interesting to talk about opportunities in the UK market. Something that we being John, Phil, and myself have talked about a lot on this podcast is that global stocks and small caps in particular have looked really cheap relative to everything else for a very long time. And I think it's fair to say that no asset class worldwide looks worse than UK small caps. Those two forces meet one another in this one geography. And I think it's just really timely to talk about some ideas there. I'd say, just to kind of kick off, part of what's always been somewhat appealing to me with the UK is you could find phenomenal global businesses because this is really just, island nation, very close to a very large continent and somewhat in between both metaphorically and physically Europe and America. And you can find these really great global businesses, but you don't have to pay U.S. valuations for them. So anyway, with that preface of what brings Daniel here and why I wanted to have Daniel share his wisdom with us, why don't I turn it over to you, Daniel, and we could start diving into the topic of the opportunities in the UK and maybe get to a couple really interesting ideas.
Yeah, absolutely. And first off, thank you guys both for having me on and very humbling. Thank you for pointing out all those lovely things. I would say, I don't know if I'm going to pass on any wisdom, but, figured out a few things and happy to share. As with anything, always up for a discussion so anyone can reach out at any time. So, recently we've been digging around in the UK. A recent presentation on MOI, in fact, was sort of described as bargain hunting in the UK. And in it, not only did we detail a new idea for our fund, but also just a handful of others that we've been in currently and then also in the past. And kind of along with an idea discussion, kind of gave an overall framework for how we sort of hunt in these sort of different waters. Of course, in the same pond, just across the way. And so basically the framework is sort of this. I'm going to kind of just talk briefly about that and then step into the UK market at a high level, and then we'll get into some ideas. And the framework really is there are 2 types of businesses in the UK that a US investor like us would be looking for, is ones that are called quote unquote UK in name only. Maybe, the founder was an Anglophile, had the listing in the UK, but most of the business is US centric, preferably. And then there's also sort of geographic arbitrage opportunity there. The multiple in the UK is depressed. In the US, there's comparables that are much higher, and they see that opportunity. They move the listing. Then you have sort of these sort of forever cheap UK compounders, and this is ones which are domiciled in the UK, predominantly revenue generated from the UK, and they are perennially cheap. But the management recognize that, and they are savvy. There's a very select few of very savvy operators on the island that they basically identify that and go, okay, well, part of our capital allocation is just going to be the slog back, 5 to 10% of the float every year, and just carry on our merry way. And then there's also that third component of those two, and we call that the best of both worlds, where it's a not necessarily UK name only, but most of the revenues generated in the US and elsewhere. But they're perennially cheap, and they're going to stay in the UK because they are, quote unquote, a UK company in spirit. And then they also have that capital return profile. And so, like, where high level, why is this sort of interesting, and why now? So, if you look at the FTSE 100 over the last, 30 years, it's always kind of traded at a 10 to 20% discount to the S&P. And, ever since obviously 2016, they had Brexit. And ever since then, that discount has been widening and widening and widening. So while it may have been 10 to 20% for ages, now we're looking at more like a 60% discount. So the FTSE 100 trades at, call it a 17 times PE multiple, whereas the US is at, I think currently it's a 29 times multiple, I think, on trailing. So obviously, huge discount. And why is that the case? Well, I mean, I think predominantly, we look at the disposition of the companies in each, and obviously, the S&P is 33% tech, whereas the FTSE is 1% tech. Energy in the US is 3% of the SPY. In the UK, it's 11%. So there are some pretty profound differences in the disposition. But overall, it was much tighter before Brexit. And so then to kind of give you some numbers as well, to kind of frame this up on exactly what happened Brexit, is GDP growth in the UK, according to the World Bank since the 1960s, was about 2.4% GDP growth per annum. Post-Brexit, if you were to take out the pandemic and that rebound, so a negative 10% and an 8% pop thereafter in 20 and 21, you're still looking at call it a 2% GDP growth rate. So about 15 to 20% less than their historical growth rate. So they have seen some contraction in GDP. And while I would say, the disposition of US investors and also and revenues derived from these companies is largely the same pre and post Brexit. Foreign direct investment in the country is also down about 20% as well. So that kind of gives you the framework of sort of what we're looking at high level, and then you look at, okay, what's being thrown out here as well. Where are the gems and some really great companies? And that's kind of where we get into a few of these businesses that we've been looking at. And I'm happy to stop there and then jump in with Elliot and start talking a few, if you want to go ahead and lead the way.
Yeah, let's jump right in. I mean, maybe it would be helpful to just make clear which one of these three kinds of setups you're going to do first. And I'd maybe just add like a couple numbers to contextualize just how cheap the UK is. The UK's forward PE ratio now is at the depths of the financial crisis levels. I think that's really dramatic and kind of wild when you think about it, because it's not just Brexit. It seems like every crisis globally has disproportionately hurt the UK more than other geographies in terms of their stock market. So it's like the financial crisis, then the European crisis, then Brexit, and then COVID. Each of these had a further derating in the UK relative to others. And then within Europe, you're nearing a 10 standard deviation discount of mid caps to large. And so there's definitely something profound going on. So with that, Yeah, what idea you want to cover first, Daniel?
Oh, I'd love to talk about sort of the one that we'd call a best of both worlds, and it's also the one that we presented recently at MOI. I think it kind of highlights sort of the best of the UK, while also the cheapness and the attractiveness of something like that staying cheap. So, if you like, I can jump in on Melrose.
Yeah, do that. Melrose is very timely, it seems.
Yeah, yeah. So Melrose Industries, and the ticker is MRO, was previously sort of a public PE fund. I think three of these co-founders listed on the AIM back in 2004, and with the idea of buying, improving, and flipping, or selling rather, industrial businesses, which is really sort of actually bread and butter for a lot of these, a lot of companies in the UK. So over the years, they had been doing that. Then in 2018, they took a big swing at a company called GKN, and this was an industrial conglomerate that had gotten really fat, and basically there was a lot of things to trim out of there. In there was an aerospace business comprised of two divisions, and then there was also a metallurgy business, an ironworks, and an automotive business as well. And then interestingly enough, to just to chime in on like how British this business is GKN, the original entity, the ironworks, made cannonballs for the cannons that actually fought at the Battle of Waterloo for the British. So that's back in, I think the business was founded in 1759 or something like that. So they definitely aggressively in the public domain sort of bought out this business, I think with a lot of fanfare and controversy, and then proceeded to start streamlining the business. They sold different portions of it, and then also spun off late last year the automotive and metallurgy business. And so then what you were left with was an aerospace pure play. And in that is truly a gem. You've got a great structures business and engines business. And these are, predominantly U.S. focused. About two-thirds of the revenues come from the U.S. This is also a business that is engineering wise. As far as my background, I was an aerospace engineer in my previous life. And so a lot of those things in my textbooks, not growing up, but were basically, some innovations that had come from GKN. So a highly reputable engineering business. And as they've stripped this stuff out, they brought on some very competent management, and they've changed that PE model to basically they're all in on Melrose Aerospace. The PE founders have been all paid out, and now we have this executive who was brought on as COO in 2019, and now he's the CEO as of this year. And this is really the first year as a standalone aerospace business. And from there, we've got the two businesses, structures and engines. And the engines business is truly world class. They have basically content in just about every single engine in the world, predominantly narrow body, and then also quite a bit in wide body. And the way these businesses are sort of structured, as well as the life cycle of an engine, is 30, 40 years. And basically, they collect a small portion of the revenue generated from maintaining and overhauling these engines. And on the flip side, they have this structures business, which is really tied to Airbus. And it's actually, so it's not as good as the engines business, but you have another catalyst here in terms of they're basically sort of whittling out some of the sort of the negative margin business. They recently sort of put back to Boeing their defense structures business recently as the St. Louis facility, and they're kind of cleaning that up. And ideally, it sounds like they might be basically selling it in a number of years once they've turned it around. And so this is a business that is world class on many fronts. It is highly focused on some of the best place you could possibly want to be in a capital intensive business like aerospace. And this is a management that gets it. So I mean, right now it's trading at single digits on earnings, and they're buying back 5 to 10% of the float each year. the way their contracts are for these engine programs is basically, even if you basically give it absolutely horrible bear market sort of assumptions, these contracts generate sort of just massive amounts of cash flow in comparison to its market cap, which they can underwrite very well out into 2060 is where they give some of their projections. And so with that cash flow on top of the regular business of leaning into building out the repair business, getting in on the next generation of new engines that's going to be starting up here recently, they're going to be sort of aggressively going after some new business, and with the CEO coming from Danaher, they're going to be really focused on cost improvements and innovation, which they are sort of in the middle of. And that fits into this best of both worlds: is you have a great business, high, a lot of visibility on cash flows, and then a management that gets it is going to buy back shares at a cheap price. And so that's sort of the basic frame for Melrose, and that's something that we're really excited about, and that's really kind of only something you see in the UK at the moment.
Yeah, maybe talk a little bit more about that engines business in particular, because that seems to be the crown jewel here. What are they exposed to? As I've been looking at this, just for full disclosure, I don't own any shares here, but I've been trying to understand the dynamics. There's the Pratt GTF engine, and then there's the GE Safran LEAP engine, and they have a little exposure to both, but more to one is what it seems. And maybe talk about how that's been a headwind of sorts, but an opportunity going forward.
Yeah. Yeah. So the way the engine business works is it's actually one of the most capital intensive in the entire industry. These are incredibly complex parts and very expensive to produce using lots of, highly expensive, very low not subscale, but low volume materials like nickel alloys and what have you. And so basically what the four engine manufacturers, GE, Safran, Rolls-Royce, and Pratt& and Whitney, they outsource different components in an engine to sort of spread around the capital intensity. And so Melrose plays a part in that, and mainly the structural parts of an engine. And the way it works is basically, say a Rolls-Royce goes ahead and says, okay, here's what's going to cost. You provide these parts. That's maybe will determine that that's 4% of the value of the engine. After you've put in your costs of developing your parts and you've delivered them, book that revenue, but then you get a piece, you get 4% of any of the profit thereafter that comes from the sale of any parts, any repairs, any overhaul, anything over the life of the engine. And the way they structure is they sell the engine basically at a loss, and then the replacement parts are 2 or 3x what it would cost at an OEM sale. So the real profit is made in the tail, and that's contingent on flight hours and the amount of how long they expect to keep these airframes in service. And so you can kind of build up a waterfall analysis of all these aircraft that are out there. They have to come in every few years. There's also repairs. And so everything's sort of not only hours related to how long they're flying, but then also sort of regulated, mandated overhauls to make sure everything is nice and up to date. And so you can build out a cash flow profile for these aircraft out into 2060 is where they put it at. And basically the way that's worked is the engines business is GKN is not only just GKN where they've had some parts and things like that, but over the years, like back in 2012, as GKN bought Volvo Aero, which was part of Volvo's business, they had actually an excellent engines business as well. They got bought out. And that's predominantly where a lot of these contracts come from. And a lot of the people that were there when it was purchased about 12 years ago are still there and in charge, and they're responsible for this sort of inking all these contracts. And so it's a portfolio of about 19 engines, which is the majority of the flying hours for narrow body and some on the wide body. And this is kind of like, so my background is also I specialized in engine design back in the day, and then won an international design award. So engine parlance and all this kind of things is sort of where we get our edge in what's going on with the business right now. Is there's basically a step change in what's going to be occurring here in the engines world and the aircraft world, is more and more efficient engines. And the way you do that is basically, the best way to say it is the engine diameter is getting bigger, but the burning part gets smaller. So you get a lot more fuel efficient engines. And one of these innovations came from Pratt and Whitney, called the geared turbofan. And this is a big leap forward. And if you kind of think about sort of scaling laws, is engine efficiency has kind of been on this certain scaling law for a number of years, and it kind of has stopped out, particularly with the LEAP was sort of the last sort of big turbofan engine with a dual spool. The geared turbofan is something a little bit different in that it basically is a technology that's going to kind of allow that scaling to then continue. So it's sort of a different environment going forward. And GE and Safran are working on an unducted fan, which is another competing technology. And that's sort of where we're kind of going, geared turbofans and these unducteds. And so why this is important to Melrose is they have, and very clever, very smartly, in fact, sort of not gone all in, but majority of their future cash flows are predicated on the success of the GTF, which has had some issues. Basically, what has occurred here in the last several years is engines started actually coming out on production in 2016, and they found sort of a bad batch of turbine blades that were cracking, and it basically came down to some contamination in the manufacturing of the turbine blades. And so they identified, originally it was 1,200 engines, and then it's kind of, they whittled it down earlier this year to 600 and something, and now that number is starting to trickle down as they sort of cycle this out. But this has introduced a lot of problems for particularly Airbuses, as a lot of your listeners are aware, is that since COVID, people jumped right back on the plane, but then all these aircraft were parked. And then at the same time, a lot of the tenured people left the industry. So repair shops to sort of service these things are limited. The airframe manufacturers are having issues, leaving Boeing aside, their issues, but just generally there's been a lack of people and all kinds of, the supply chain is very, very long in aerospace. And so it's just taken a number of years to whittle through. And so you've had engine problems from a supplier on top of that. And really what's happening here is they've identified this problem. It's really more of a quality control issue that they just have to cycle through versus a design issue with the geared turbofan. The technology is sound and the engine itself is sound. It's just simply going through a teething issue at pretty much the worst possible time. They're rolling this out still in production. There's not really a repair network to cycle these engines, and nor are there really a lot of spare parts either. So it's taken some time to really get through. And that is sort of like the crux of also why are we so lucky to see something this cheap? So our insight into that gives us a lot of confidence that the GTF is going to be something that's going to basically be something successful in a number of years. And so that's primarily where we sit today on that particular engine.
And so to be clear, right, this is not a part that MRO supplies to Pratt. It's a different part, right?
Yes, and this is where it also gets really fascinating. And this is also, again, a lot of cleverness on Melrose's part. Is they very astutely were the best way to generate cash flows in the aftermarket is to not have to provide a part. So they provide basically non-rotating parts, structural parts, so casings, different components that hold the engine together that are not the super intense, complex turbo machinery, the rotating stuff inside. And the issue for the GTF is in the turbine, which is like the most sort of hostile operating environment for any material. And so the turbine blades are very complex and very difficult to manufacture. And they basically say, no, we're not going to deal with any of that. So when an engine has to get serviced and they have to repair a fan blade, say MTU Aero made those blades, they provide the blade, they book the business, but then it's also lower margin because it's also they've got cost of goods sold. Whereas Melrose still gets a piece of that business because it's that entire profit pool of everybody. But because they haven't had to provide a part, they just simply collect a check, which is really what's so fascinating. It's a really smart business strategy of being in on these contracts, but without having to provide any parts and labor in the aftermarket. And so that's just literally a stream of 100% pure cash, which is basically where that portfolio is going after we get past the GTF.
Wait,
And
explain that a little more. So what exactly are they getting paid for here?
so they're getting paid for basically their work up front. At the beginning, the Pratt and Whitney said, "Hey, the GTF will cost 7-8 billion to manufacture and design and send out the door. That's our development costs. You, Melrose, will provide some parts. They negotiate what the percentage of the risk and revenue sharing agreement would be. In this case, 4% for one variant, 7% for another. And so then they provide the part, and then they're grandfathered into basically a share of the profit pool thereafter. And so that is basically just a contractual arrangement for anything in that profit pool that they take a piece of thereafter.
So the largest consequence then of what's happened with the GTF is mainly that the flight hours on the GTF are lower than one would have expected at this point had the launch gone smoothly. And so they're getting less of this super high margin revenue in the aftermarket.
Yes. So the engine is in production. So there are several phases here. One is the upfront cost to design the engine. Then when you are in OEM production, which is like what the GTF is in currently, is Melrose is providing those parts. So they are booking revenue and cost of goods sold. And that is predominantly, a lower margin business than just simply collecting a cash check. So we have to get through that OEM delivery phase. And then when they're all out in the world and they're flying and being serviced, that's when it's sort of in this sort of cash collection phase for Melrose. And so not only has the GTF issues sort of set that back, it's also introduced some concern as to the viability. I think we've had a lot of discussions with people that are concerned that the engine is not viable or what have you. But I think those concerns are why the stock is where it's at, but not certainly why it deserves to be in the future.
Do you ever have to replace the Melrose component?
No, honestly, where the structural parts that they provide, it would have to be a catastrophic failure of the engine. That would probably be, put it lightly, is probably the end of the airframe. They're basically in the stuff that holds the engine to the airframe, and they're also in the structural parts of like the let's call it the Bernie part of the engine itself. So it's not something that ever really has to be replaced except in a catastrophic event. But on the flip side, you have someone like MTU who's providing a lot of the turbo machinery, and they're also doing a lot of the repair work. Also with Pratt and Whitney, they have an 18% share on the GTS, which they are currently sort of eating a lot of crow on, as they have to service the engine. They also are going to be part of repairing a lot of those parts. We're working with Pratt and Whitney. Pratt and Whitney was actually sort of their parts are at the issue of this, but a lot of those costs are being borne by those two partners, whereas Melrose is already they expect a small charge of about 200 million pounds, maybe, but technically it's not a development cost. It is a manufacturing issue for them, which is why they expect to not have to take any charges. But in the meantime, they're all just Airbus is getting as many aircraft as they can out with the GTF. It's on the A321neos, and then also cycling through sort of these other airframes that have these engines that are just sort of sitting on the tarmac, and that just sort of delays that cash flow profile. But we've got visibility at the end of this issue coming here in the next year or two, and also this is not without precedent in this industry. The narrow body that actually Melrose has quite a large piece on as well, that's sort of a large chunk of their cash flows at present on those RRSPs, is something called the V2500. And this had the exact same issue actually as the GTF 5 or 6 years ago. The only difference is this issue only lasted less than a year because there was a lot of it was an older engine. We had a mature network of repair shops and then plenty of spare parts. So it was just simply a man hours issue versus here we're dealing with a handful of supply chain sort of not mess ups, but they're just happening at the worst possible time. It's taking longer. It calls into question for some people the the viability of the engine.
And so, yeah, the viability of the engine seems like something the entire industry is investing around anyway. That being like the airlines, but there's also questions. I read that FT piece, and I haven't read the UBS analyst piece, but some people are calling into question the viability of the long-term cash flows of the business. Curious how you think about that. And that seems to be one of the foremost reasons why the stocks really got in cheap here, beyond a cheap starting point being a UK orphaned small cap.
Yeah, absolutely. Look, there was a lot of problems with the methodology of the UBS report that had come out from an analyst putting it. I had a very negative report, but it was some fundamental misunderstandings of how to basically underwrite the cash flows for the engine programs that they're in. I mean, very materially misunderstanding, I would say, is part of this is, getting into sort of accounting conventions and what have you. And I think, to use the British term, if you're arguing over some of the accounting on booking booking the business that's somewhat deferred, and then it's only part of the aftermarket cash flows, you've kind of lost the plot. So this was basically he was underrepresenting the cash flows from this business pretty materially, and that flowed through in that Financial Times piece, which took it verbatim. To the management's credit, and why we're also sort of really interested in this stock is management gets this. They tried to walk through these sort of delicate assumptions for these cash flows, mainly because they get a lot. These assumptions don't come from them. There's no accounting manipulation in them, in that these assumptions on deliveries and what have you come from their partners. They have no say. They have no wiggle room. They've been as conservative as they can in accounting for it. But there's basically, we're going to expect to see the company come out here in the next several months. They'll probably have an analyst day. They're going to come out with their latest numbers, and then also they're probably going to have sort of an accounting day where they go through in detail how RRSPs, these contracts that we've talked about in depth, how they actually flow through the financials, and why the analysts that very boldly come out and said that they're materially overstating their cash flows is actually quite the opposite. So I hope that helps.
Absolutely. All right. So we've covered this one pretty well. You have another idea from a different bucket or same bucket? What other ideas should we be thinking about?
Well, and I think, yeah, so that's best of both worlds. But I think what's really interesting, obviously, is everyone loves talking semiconductors. And, it's interesting as well. This company we're going to talk about is not in the FTSE 100. The composition of it is 1% technology. And this is actually a technology company in the UK. And I'm referring to Alphawave. And this has been sort of a very interesting story for a couple of years now. This is basically a U.S. business now. It's sort of a magnum opus for a particular engineer founder. His name's Tony Pialis. And he's got a bit of a reputation as being a swashbuckling kind of guy. He was at he started several small firms, and it's selling a type of sort of communications technology, I guess you could say. And then basically got bought out by Intel, had a plan for sort of a new way of getting chips to talk to each other called SerDes. Wasn't really getting any traction. Intel left. started his own place, bootstrapped it with a few people and internal capital, and then basically put a whole business together in a number of years and jumped right to the top in terms of selling IP. Was pretty phenomenal. Also brought along, of course, a lot of people from Intel left and went over to AlphaWave. So this is a business that was listed in the UK. I would say, engineering wise, they are fantastic. I think on the financial side is clearly something that they have been working on improving now in the last year or so. But that's been something that's stubbed their toe over a number of years now. And this is a business that is in UK in name only. I think we can get into it from there, Elliot, if you want to jump in.
Yeah, so in full disclosure, I do own shares in this one, unlike MRO. I know this one quite well. I hope I do if I have a position. And I think it's a really interesting case. Like, first off, the whole reason. By the way, I didn't know you were going to bring up this one next, so that's interesting. I like that you went there, though. I think it's timely given they reported it this week, and it was about as messy as their typical report, but in a very different direction, a more constructive one in some ways, if you were to call a mess constructive. Um, the very reason they listed in the UK, I think, is somewhat timely in light of the China stimulus coming back into play this week. They listed in the UK as a Canadian company with the US their biggest potential market, because in the UK at the time, and we're going back to 2021, the US had already passed really strict restrictions on selling semiconductors and semiconductor technology to Chinese and Chinese-backed enterprises. And AlphaWave, when they started, that was one of their bigger customer bases. So the UK had not followed the US in going through with these restrictions at first. So it seemed like a way the company could kind of have, as you've called, the best of both worlds on an investment setup, a different kind of best of both worlds, where they could sell to the Chinese market while being publicly listed and not dealing with the US. So there were other issues, right, at the time of IPO, including a high valuation. But why don't you go into like what put this on your radar the very first time and some of the
Yeah,
background there?
absolutely. So one thing I enjoy doing is leaning into my sort of engineering background. I almost uh, I have a lot of friends that have worked at various tech companies as well, so it's just kind of ring them up. And actually, how I came across this business was one of my friends was like, "Oh yeah, I'm using this one little company, AlphaWave IP. Fantastic technology, way better than any of the competing guys. Just really small, scrappy group of people." I was like, "Okay, great." Took a look at the stock price. They'd gone from, call it 400 to 100, and you're going, "Whoa, what happened here?" And so yeah, they IPO'd in 21. Um, Obviously a nice multiple at the beginning. And then shortly thereafter, the Financial Times came out with, I think what would this be called, a hit piece, and sent the stock sort of rocketing downward. And the premise there's shady ties between management and these Chinese customers that were related to Suharja. And basically they basically said there's smoke, but they couldn't identify the fire, and that was enough to scare a lot of people off. um, Over time, that's obviously, by the time I took a look at it, every element of that had already kind of been disproven. They had been basically saying they're going to pivot from all these Chinese contracts. This was a friends and family sort of relationship, and that's how they got started. And they were going to be kind of taking those IPO proceeds and investing in some businesses that were predominantly US centric. One being a design house called Open5, which was actually Open Silicon, which was Intel's original sort of custom silicon team back in the early noughts. And so that was sort of the background, and that was also sort of the context that people kind of had the ick factor, which we kind of always really like, because as far as the actual products themselves, it sounds like they checked basically every box you could possibly want for a technology stock. And clearly, the financial side of things, they were working on sort of fixing. And so that's kind of how we came across it. And obviously, this is very cheap optically on many levels, with a lot of growth potential here. I think the way the world evolved, starting from last year, it's really sort of played into their hands. Design activity for chips is at an all-time high. This business also, to their credit, has been getting in on a lot of that activity, and they're really a newcomer. So there's a big market that they are addressing here, and they basically have very little share, and so that's sort of where they sit. They've got a couple of new products coming out in the next year or so that I think will turn the tide as far as sentiment is concerned, and certainly the financials as well.
Yeah, it's interesting. One of the things both these companies have in common beyond being UK listed and oriented is that they're both the subject of FT hit pieces. So there's something there. And, I think one of the areas that I could add to this a little bit, because I can't really speak to the engineering side, but I've spoken to enough engineers to have some faith that when it comes to the quality of their offering, they are second to none. And every engineer recognizes Tony and his team from his first startup, Snowbush. In fact, I'd spoken to people at some large tech companies, and they still call them the Snowbush guys. This group from Toronto, where it's one of these pockets of like world-class digital analog programming. It's one of the few in the world where that's like one of the few areas in the world. Who would have thought Toronto truly has a special calling there? And it's partly because of the team that founded this company. So engineers really appreciate it, but you speak to people in the financial community and it's like, oh God, this is a disgusting company. And part of that has to do with they'd had a very immature finance function. They had a banker running finance to start, didn't have many employees in the finance office, but they were growing incredibly fast and they made 3 acquisitions in very short order after IPO. And so things just weren't presented cleanly, nor did they come together quickly. And now one of the things that I find super interesting is they hired a new CFO, and his name's Rahul Mathur, and he was the CFO at Rambus. And he built a ton of credibility and oversaw a significant appreciation in Rambus's stock during that time. And notably, one of the most prominent assets behind Rambus kind of emergence from post-dot-com stagnation that persisted nearly 2 decades was Rahul's management of the Snowbush asset. Snowbush, after 2 acquisitions, ended up as a critical piece of Rambus itself. And so the gentleman who's now the CFO at AlphaWave, I think, really knows what you could do with a product created by Tony Pialis and his team. So that's something that I've found to be incredibly compelling here.
Yeah, and like everything in the UK is cheap for a reason, but what happens when that reason is no longer there? And I think for Melrose it's the GTF, and I think for AlphaWave it's the finance function, and I think they've reached a point of maturity at this point. We take a look at job listings and see them hiring tons of FP&A people and things like that, and it seems like they might actually be able to turn the corner here into the next year. And I think as long as they keep up with their activity levels and their winning of new business, the finance side comes along for the ride and shows people that they are who they say they are on the engineering side. I think that'll be a nice change.
Yeah, one of the things you could do, like this being a UK company, and this is part of what originally drew me to AlphaWave, you could simply hunt for the US equivalent and ask yourself, like, what might be the most closely analogous US company to this? And I'd say it's this company, Credo Technology Group, ticker CRDO, on the NASDAQ. And Credo is going to do less revenue than AlphaWave this year by a considerable amount. Yet Credo's worth $5 billion, over 20 times revenue, while AlphaWave is worth less than $1 billion US. Might be over 1 billion US again today, but it's been a volatile week. And there's really functionally not all that much different about the two companies in how you'd build the narrative around them. Both have critical components for the most sophisticated data center operators in the world. And yet, you have a really, really big valuation gap. And that alone is interesting. So I don't want to overplay the AI story. I think that's part of why in the US markets there is this AI bid. And so I wouldn't dare argue that Credo is anything remotely cheap, nor would I argue that AlphaWave should trade at the same valuation as Credo, but it's a very simple comparison that you can make and just see this transatlantic divide in action. So that's one thing I'd add to this for sure.
Yeah, and I think that gets into sort of the framework that we look for in these kind of businesses, UK name only. If there's a sort of potential for a geographic arbitrage play in this, and you can see a little more clearly between both sides where things kind of stand on one side of the pond and then the other, and a management that understands that, like they know that they're trading too cheaply for what they are, and so how do they remedy it? And they've got a plan. So it's just interesting.
Any other UK companies in?
Yes, actually. So another in our framework is so we had UK name only, best of both worlds, and the other part of that was cheap UK stocks that you want forever cheap. And so we've been talking not ad nauseum, but certainly plenty on a UK home builder called Vistry. This is something that we've owned for a number of years, and so it's sort of kind of come into its own finally in the last year or so. And so the UK housing market is sort of is I wouldn't say horribly distorted, but it's way more out of whack than the U.S. currently, which we've all seen the home price appreciations that are still happening at all around certain metro areas at the moment. But if we are short several percentage points of housing stock, they're short about 25%. So there's about 28 million homes in the UK, and they're short about 4 or 5 million. And so how do you get around remedying that? Well, and again, it speaks to sort of understanding the differences in both sides. While everyone here, the UK is why it's so attractive. Also, is similar laws, similar language. And similar culture, but there are at least linkages there where we can relate. Although I would say I have a friend of mine that always basically says you lot like Rambo, you like the brashness and the flaunting, and they more like Nelson, a sort of a diminutive, sort of softer spoken sort of hero. And so with that in mind is, thinking in terms of what's different here is a lot of the UK housing stock that was rebuilt after World War II was basically social housing. And this was basically local communities having associations and basically small sort of municipalities fund and build, affordable homes. And over a number of years, there's basically two modes of building in the UK. Is it's sort of the traditional house building. You get your permitting, you buy the land and all that, and you build a house and you sell it. And there's another side called the affordable side, the partnership side, is where you partner with the local authorities, the government, and the community as well to build affordable housing, smaller homes closer together, and you do it at a lower margin than you would for a typical home, and a lower price as well. And what this all sort of amounts to is you have a business where you're sort of at this virtuous flywheel. Is you're taking housing stock that the municipality basically gives you. You tear it down. You get it at zero cost. You tear it down and you put up an affordable home, and you sell it at a low cost, and you take a small profit off of that. But because you put up very minimal amount of capital, your returns on capital are actually phenomenal. And you basically you do this sort of while the business is predominantly sort of London based, you do that all across the country. And so the best sort of analogy we've said, and I think it's still applicable, is NVR in the U.S. Where they took an options sort of model where they basically only buy the land when they actually have a sale. They get given the land and then they only basically build the house when they have a sale. And it's to these sort of, I would call them capital cycle agnostic uh, house associations and local councils. And so in the last year, we were originally in Countryside, which was basically kind of going under this transition from traditional house building with this partnerships model to all in on partnerships. And then there was basically, as that comes with UK stocks, is it gets too low and it gets ridiculously low in terms of valuation. And then someone tries to basically bid 20-30% over that current market price and take the whole company for a song. And a lot of the US shareholders basically balked at that. And then eventually it got bought by this company, Vistry, which was run by this excellent operator named Greg Fitzgerald. And the premise is merge the two entities with the partnerships of Countryside being the gem, and they'll put it in with their partnerships business. And then late last year, they announced that, hey, what we're going to do is we're going to go all in on partnerships, and we're going to wind down the traditional home building, and we're going to basically make sort of a giant in the UK of a partnerships business. And what we're going to do is we're going to build up to a certain level of partnerships homes per annum. And then once we get to that appropriate sort of earnings level, we're going to just basically buy back, the algorithm here is 50% of their after-tax operating profit. They're going to basically just buy back shares. They don't need a lot of capital to grow. It's just something that grows single digits, but they're constantly this is a share cannibal. And it's sort of another one of those beautiful businesses where the community, they build out these plans, and so they have line of sight for the next 8 years on home building. And because of that, they also the supply chain for the houses also is very different than traditional house building. Is they can plan ahead with the constructor, the actual builders, the materials providers, and you have a very sort of much smoother run business. And you can also get actually volume discounts and price discounts from contractors and things like that, because they know that they're going to have steady work with Vistry for a number of years. And so that it creates sort of also an advantage there, where you wouldn't necessarily expect them to make a great return on capital with much lower priced homes. So I think I'll stop talking there. So if you want to chime in there, Elliot.
Yeah, one of the things that stands out, I don't own shares in Vistry, but I find interesting in this story the idea of moving to a capital lean model who repurchases shares at a prolific rate. And it's hard not to, from my seat on this side of the Atlantic, look and say, hey, this is a company that's trying to be a whole lot like NVR, which kind of pioneered and succeeded tremendously with that exact model. And it was surprising to see how long it took U.S. home builder peers to even try to copy what NVR has rode to immense success, like Lennar is over the last few years moving to that capital lean model. But here you have a UK company who seems astute in observing, what worked on the other side of the Atlantic so well, and how can we use the unique contours of our market and take those learnings and deploy it in a similar way. And relatedly, I do think it's notable. I was just looking it up. I think maybe he's no longer there, but Jeffrey Ubben, formerly of Value Act, was on the board of directors of Vistry. And it does seem like they have a little bit more of the influence from US-based investors in order to kind of, maybe adapt best corporate governance practices and strategy in a way that I haven't seen some other like purely UK companies willing to listen to. Curious your thoughts on that, like what's going on.
Yeah, and that's what we look for is, making analogies without the context. If you're just saying MVR history, and that would give me pause if I just heard that. But when you dig a little deeper, is one is the U.S. shareholder base that basically is helping them enact that plan, but them understanding the differences between the two and actually like walking it through. And this is sort of where we get really excited is when we see, while we can look and see the cheapness of the overall market, there's just a few of those bright spots where you see operators that really get it, and their method of communication on it is also clear. Now, there's a book I really love as far as investing goes, and it's Peter Cundill's "There's Always Something to Do." And part of his process was, if he's going to invest somewhere, he's going to go and visit. And I think that's obviously, I think that'd be great for everyone to go be able to do that. But seeing how people actually communicate in different cultures, even if it's the same language, you'll never hear a UK executive say that something's great and it's absolutely fantastic. And there's not going to be. It's much less about the narrative there. There's going to be much more understated. But even still, when you have understated executives sort of wield with confidence, their capital markets knowledge. Greg Fitzgerald, for instance, during the depths of the financial crisis, did a rights offering with his other home building company he was at, so that he could basically have a bunch of capital to buy up land on the cheap. Like those kind of little signals in there kind of tell us that someone knows exactly what they're doing. And those are the kind of special people we want to partner with as well. And I think that's what also makes this somewhat unique is it's not just a bunch of people behind a screen calling, calling two things the color blue. We actually can see the shades of differences and why this part of that analogy is accurate.
So one thing that's a little challenging coming from this side of the Atlantic is the Vistry model relies heavily on these partnerships with municipalities and local government in the UK. And that's something I'd say is incredibly foreign to me. Right. So how do you get comfortable with that relationship and how to understand those dynamics?
Well, what you have to understand then is how they go about interacting with the community. I don't say you have to be an expert. I would joke that if you kind of want to have a sense of what it's like, I would just watch Clarkson's Farm to get a sense of local planning communities and what's required to jump through the hoops over there. But jokes aside, you don't need to underwrite. The understanding is, do they understand what makes it work? And really, it comes down to Vistry is in, I think there's basically 30 different operating offices, and they're in these communities. And part of what makes this business so unique is that it is an interactive function with that community. So when they're building for these people and the communities, they've got flyers out there. They do lots of clever things to basically interact with the community. It's not like gentrification where they're just displacing people. The company is very sort of savvy in building in one spot, moving people into another, and that those social housing people move into new social housing, well, then they tear down the other half. Or they've done also really clever things where maybe there was, I think one community outside of London, it was a tad sketch. And on a corner where there was drugs being dealt, is what they did is when they rebuilt it, they basically took a couple of local cops and gave them the homes right there. And then that sorted out the whole issue, putting out flyers and interacting with the community. And these local sort of offices that's the primary function. It's part house building, part community relationships. And I think that's somewhat different. And that's obviously very different than the US. But it's something that once you get an understanding for the different layers in the UK housing market in which they deal with, and you see that they deal with it quite appropriately.
Got it. That's very interesting. And, just back to the corporate governance, I think it's pretty incredible that this is and capital allocation, that this is a company willing to so heavily acquire their own shares. Because one of the things I've even engaged with some UK companies, and try to encourage them to use their excess capital to repurchase shares, and they'll do things like special dividends or complain about how cheap their shares are and yet be unwilling to act on it at all. Do you think that's mainly because of the U.S. investor influence, or do you think are there any risks to them keeping on going with this strategy because it is so different? How do you think about that?
Yeah, no, I think, and I think if you look across, the UK as a whole, they do, as far as when it comes to capital allocation, they're much more dividend heavy. They seem to sort of would rather do that than buy back shares. But I don't think that there's really a risk as far as Vistry is concerned in terms of their strategy. Clearly, there's been rumors in the last year of some PE firms looking at maybe doing a take under that was thoroughly batted back. And basically kind of understanding that they know sort of where they sit. And I think what's kind of important here too is it's not these are not high profit margins businesses. I think what's interesting in the UK is there's a high degree of sensitivity on profit margins and not necessarily return on capital. And so this is a business that's selling homes at a 15% gross margin, and I think net margin is above 10%. And so it doesn't look to say even a politician that would be looking at it like some sort of price gouging or what have you, where that would call into risk some sort of um, some sort of campaign against these over earning home builders or something to that effect. I think it's much more, while they are very understated, I think the nature of that business is something that doesn't really call attention to itself.
So pulling back, taking a level up, we've gone through some really interesting companies here. Like, what are some of the most notable and profound differences between observing UK companies, their behavior, maybe their reporting conventions, etc., versus US companies?
Well, as far as I would
Anything
definitely
that
say,
comes to mind. Yeah.
well, the way I come for it is basically sort of interactions with investor groups is, and what the incremental buyer here is in the UK. And the UK sort of, it seems that they are more comfortable being sort of as backward looking, and they'll wait till something happens and then they will sort of give it any credit whatsoever. Whereas a US investor will go ahead and jump in and ahead of something and anticipate with a little more optimism than, say, the typical UK investor. And I think that's also part of that clash in cultures is there's a lot more sort of understatement and conservatism in the UK base versus the US. And so part of that opportunity is that we're seeing is jumping ahead of those kind of positive movements, whereas everyone was just sort of like, well, we'll just wait and see what happens.
Yeah, that's pretty interesting. And, definitely seem more myopic about margins in the UK. I've seen some companies go through, good growth, but with bad margin, and there's just no trust it'll ever come.
Yeah.
And I've seen, like really, I think the semi-annual reporting creates an interesting dynamic where analysts update coverage way less frequently. One of the things that scared me as an American investing in these companies is although analysts update way less frequently, there seems to be a lot of chatter that I'm not on the ground for, where people who go to some of these conferences are told with a wink and a nod, like, you start mysteriously seeing the stock drop day in, day out, and you're like, what's going on? And it's like, oh, well, they didn't update their estimates, but they do know that it's going to be lower earnings than had been expected. Stuff like that seems to happen far more frequently. It's both on the up and down side there. Have you noticed that, or is that just me? I guess.
No, for sure. I mean, I think in Melrose it was really quite apparent as after a call it a middling report, margins were maintained. There was a little bit of a headwind as far as some of the structures business as well, supply chains sort of keeping things from the business leaping forward as expected. And the stock had a very strange reaction. Afterwards, it kind of popped back and then started just sort of falling apart. And then at that point, you know something on the ground, and that's part of the risk of, as well as you are. While you can do some primary research yourself or through friends, and and the rate of change on some of these things that happens like that is you probably can't react as fast, which is again an emphasis on being just hyper critical on business quality, because in the end that's what's going to bail you out. But the stock started to move, and we're like, oh well, someone's talking. And sure enough, I had to ask around and get some idea within a day that there was a millennium in the ledger. They were pushing a narrative, and then sure enough, this UBS report came out and then took the stock down. And it was just completely out of left field, and the company was enraged, really. Because they gave the guy, they answered every one of his questions, but he went ahead and came out with that anyway. And so that was sort of possibly a combined effort there. And so you get some of those kind of games in the near term, which you look out far enough that you'd be happy in a year from now should the business perform as expected, where you're like, oh, that was a great opportunity. And you got to thank some of those kind of moves while they hurt in the near term.
By the way, you kind of I think glanced over, but touched on one of the interesting differences there. You could actually see any short in a UK stock. I think it's over 0.5% of the company. And so, I think that creates a different dynamic in the market as well. And they have to file like the next day after that position is established, it's filed, and then it's updated constantly as it changes. So there are sites where you could track short interest of these sizable shorts and see what's going on and see who's coming into and out of the ledger on the short side.
No, that's it. Oh, so go ahead. Sorry.
Oh, no, go ahead.
Oh yeah, no, the disclosures is a little more rigorous than us. I think on the short side, it's very helpful to see who is openly shorting the names and what have you. But it's also, for the businesses we're in, is these we're looking for those that are just share cannibals, and so it's also nice that you get an email every morning from a disclosure that MRO or Vistry are buying back X amount. They bought that many shares at that price that day, and you can kind of track sort of exactly what they're doing. And so you get a real-time look at, are they following through on their plans? And for us, those kind of share repurchases is always something nice to wake up to in the morning.
Right. Yeah, that's such a difference. And I do feel like, I mean, even though they report, or I shouldn't say even though, because it might be a good thing, only twice a year, in those twice a year reports, there is way more detail than in a typical American company press release. And companies tend to hold annual capital market days far more frequently that give really detailed looks at their businesses and their strategy. And I think some companies I've seen who are like competing mainly against conglomerates, but are a focused business, they've bemoaned the fact that they have to speak with a lot more color and candor than their American peers. That may or may not be a hindrance competitively. I think some companies overstate how much that hurts them competitively. It is, however, a fantastic thing from a shareholder's perspective. And it's also really fantastic if you are an investor, an American conglomerate who's competing with a UK focused company, to get that kind of color that you're looking for on, maybe one division.
Oh, that's an excellent point. I think that brings up also something what's so interesting on MRO, Melrose, is these every engine manufacturer and a handful of the suppliers all have these RRSP contracts, but this is the one business where it is the majority of their profit and at least half their revenue. And so it's very visible what this cash flow profile is. And they have to be delicate with the assumptions, but it is much more visible through them than any other sort of player in aerospace. And while we'd argue, if you I think once they sort of explain it a little more after this particular report, we think because of the visibility on this cash flow profile, this deserves probably a higher valuation than say a typical aerospace supplier, just given the visibility of it all. Is that also has kind of kneecapped them as well as they've been as visible as transparent as they can be. But even still, you get it's so unique in the aerospace world and so visible to everyone else that it also is a source of confusion, and that kind of actually hurt them. And so now they have to kind of explain and spoon feed more than a an MTU Aero probably would, or even like certainly Rolls or Safran would had to. And so that's kind of a funny observation. I would agree with that.
Yeah, it's definitely been one of the fun parts about looking at the UK, the level of detail you get on companies. And, alongside the frustrating parts, like I was mentioning before, about having to maybe teach some of these companies about what good capital allocation looks like. I do think that's one of the biggest missing areas. And it's interesting that in Vistry you found a company that's approaching it with a more US like perspective.
Yeah, and I would say Melrose is probably fast behind them. I would find it, I find it interesting too in terms of disclosures. Is they're making some capital investments in basically you call it you know it's additive manufacturing, but it's very expensive 3D printing on some of these sort of alloy parts that they're making. And when they press release, they say, look, we're going to be spending X amount of money and we expect over a 20% IRR. And they people got mad they didn't disclose until later that they said they gave the project IRR, but they didn't say who exactly was the customer because they didn't want to give it away. But it was GE that's actually backing it for their NX engine. But it was just sort of like be more be a little more explicit.
Mm-hmm.
A little less understated on that front would be helpful, particularly when it's something like that sensitive. But in either case, it's something that's going to work out really, really well.
Let me ask
But
you this on Melrose, right? I kind of should have picked up on this a little more earlier. Danaher former running the business. So is there strategy on capital allocation geared far more toward M&A than
uh,
capital returns?
so that's interesting you say that. I think the Danaher side of Peter Dilnot is the executive, as he was there for about 7 years and then ran a couple other different businesses and was brought in as COO to Melrose in 2019. It was just a year after they bought GKN. So he was the COO that got sort of helped clean up the operations of the aerospace business, and is now that it was proclaimed the CEO early in March. And the Danaher part is something I think that's uh, not just saying it to say it. Is there's that idea of costs through innovation. And I think that's the manufacturing excellence that they're kind of going through with this additive manufacturing. So like the engines business, it's over 50% of their cost of goods sold is materials costs. And with by 3D printing most of this material, most of these parts in time, drops the cost of materials by 80%. So that's something that they're working on right now, and that's organic investment. But I think what makes this unique is there really is no one to buy in the engines business. So this is really a capital return vehicle. Once they sort of eventually sell structures, they know they have a game plan. They know exactly. They've been very articulate on how exactly they think about it, and I think it would really it would surprise and almost delight a U.S. investor talking with them about their capital allocation because it is so U.S. like, but it is also sort of. I don't, as far as we think in terms of our frameworks, I don't think it'll ever list in the U.S. I think it is they're very happy to be a British company, but in that sense, is they are allocating quite appropriately.
Got it. Very helpful. Well, Daniel, this has been a really interesting conversation. We've covered a lot of ground on what it's like for an American to invest in the UK and what it makes for interesting companies. And checked all three boxes on the kinds of setups. I was happy to be able to contribute at least to the thoughts on one of them, but really appreciate you joining us to share your perspective here today, and look forward to having you on for a couple more episodes and digging into some maybe US, maybe not companies out there.
Yeah, absolutely. And I thank you guys for your time and letting me sort of go on some of the things we find so fascinating about the UK capital markets, and looking forward to doing it again.
Yeah, thanks both of you guys. This was so terrific. Thank you so much, and looking forward to talking soon. Take care for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.